Hi class, we just had a video on investments which we talked about trading, held to maturity, and available for sale. We've looked at the characteristics of those things. Now what we're going to do is we're going to look at actual transactions associated with these. So in this video I'm going to look at trading, then we're going to talk briefly about held to maturity, and then in another video I'll talk about available for sale. Okay, so right now let's look at a trading transaction. Let's say that it's November 10th and we're purchasing some short-term investments. They're going to be trading investments, and we're paying $20,000 for these. So this is the journal entry. We have an asset worth $20,000 for these trading securities, and then cash of $20,000. Okay, that's reducing our cash because we're paying cash for this transaction on this transaction. Okay, let's say at December 31st, so 12/31. Let's say the value of these investments has now gone up to $20,100. So just right up here to the side, I'm going to say it increased. Just write an arrow up. The value has increased to $20,100. Now remember, with a trading security, when we have an increase in the value of the portfolio, then we adjust for that. We adjust for the fair market value. We do that in the income statement. Okay. So here is our journal entry. We're going to have a fair value. This is a new account to us. Fair value adjustment. It's a long account title, dash trading. And the adjustment is for $100 because the value went up 100. And then we have an unrealized, because we haven't sold this yet, so it's unrealized, an unrealized gain. And it's going to be recorded on the income statement. So we're going to say dash income because it's actually going to be income on our income statement. We're going to recognize it as unrealized, meaning we haven't sold it yet, but it does increase it is a gain, so it does increase our net income by $100. So it's treated like a revenue, so a credit will increase it. This fair value adjustment, this is going to go along with this account right here on our balance sheet. So we'll show that the investment was purchased for $20,000, but that we have adjusted it up $100 because the value of this investment has gone up 100. Okay? So let me just reiterate again. We're looking at a trading securities, and when there's a change in the value of the securities for trading securities, then we do recognize that adjustment, that fair value adjustment up, and it's recognized on the income statement. Okay? What happens then in January? Let's say January 10th, we sell. Let's see, we sell part of this. We sell $1,000 worth of our $20,000 trading investment. Okay, we sell $1,000, and let's say the selling price on those securities is $1,200. Okay, so we're just selling a portion of these on January 10th. Well, the journal entry is pretty simple. I think you'll understand this. We get cash in of $1,200. We're going to recognize a gain on sale of our investment. Gain on sale of the investment, and that gain is a $200 gain. So I'm going to put a credit, $200, and then investment. Let's see, short-term investment dash trading, because we have to eliminate it out of that asset account. We've got to eliminate $1,000 out of here, so we're going to credit this $1,000. So this shows the whole story here. We got cash in, that's an asset, so cash goes up $1,200. We have a gain on the sale because it cost us $1,000. We're selling it for $1,200, so we have a gain on the sale of $200. This is a realized gain versus this unrealized up here. This is actual realized because we did sell it, and then we have to eliminate the investment out of the investment account, the short-term investment dash trading by crediting it $1,000. Okay, so we've looked at trading securities, some examples of transactions. Now what we're going to do is we're going to move quickly. This will be simple to our held to maturity. Okay, so we're going to look at this one right here. So if you recall, held to maturity means that we're planning on holding it for the life of that security. Now remember, held to maturity are only debt securities, because equity securities don't have a maturity date, okay? Debt securities do. Remember, once again, those are like bonds, notes, maybe CDs, where they have maturity dates, okay? These things are going to earn interest over their life. There's no fair value adjustment. If the price goes up or goes down for these items, we do not adjust for that, okay? In later classes, in advanced accounting classes, we'll talk about how we amortize this information, how we amortize the value, the premium or discount on these items. But we record them at cost, and there's no fair value adjustment associated with them, okay? So for example, if we were to purchase this for $20,000, let's say this is on November 15th, we would have, in this case, let's say it's a long-term investment, held to maturity. I'm going to abbreviate, held to maturity, and I said that we purchased it, I can't remember what I said, let's say it's $20,000, I may have just changed that, and we would have paid cash for it. So this is how we record held to maturity investment, okay? Long-term investment, we're planning on holding it for the long term, held to maturity, 20,000, cash, 20,000, okay? Now you might be wondering, wait a minute, held to maturity, wouldn't it always be long-term? Not necessarily. We could be purchasing a CD that's only like 90 days. On a 90-day CD, we're planning on holding it till maturity, which is 90 days. That would be a short-term investment in held to maturity, because we're only going to hold it for 90 days, but that is the maturity date of that. So you have to look at the actual maturity date of the investment, and that's how you would categorize this. Once again, if this long-term investment went up in value from 20,000 to 25,000, it doesn't matter. We're not going to adjust for that, okay? We're not going to adjust to the fair value, unlike what we did in the trading, okay? Trading is our intent to be buying and selling these stocks, okay? So that's why we are going to adjust for that. This we're planning on holding to maturity. So prices may go up, they may go down. We're just not going to adjust for it because we're planning on holding it till the maturity date, all right? So I hope that helps. We've talked about trading securities. We've talked about how we handle held to maturity. Now the next video, we're going to talk about available for sale, all right? Available for sale, once again, the definition is a little bit strange. It's not trading and it's not held to maturity, so then it would be available for sale. All right? Thanks, class.